September 2008. A conference room in Manhattan. The phones will not stop ringing. Around the table, some of the most powerful financial minds in the world are staring at a number on a screen, and not one of them knows how to make it go away. The number is $14.5 billion. That is how much cash this company has to produce right now, tonight. Money it simply does not have. Outside this room, the United States government has a few hours to make a decision. Let this company fall, and the global economy may go down with it. Save it, and they break every rule about who gets rescued and who doesn't. And here is the part that should stop you cold. This was not a bank. It was not a hedge fund. It was an insurance company. The most boring, most cautious, most predictable business on the planet, the business of selling safety, had somehow put a gun to the head of the entire world economy. How? How does the sleepiest business on earth end up hours away from destroying everything? To understand that night, you have to understand what an insurance company actually is. And it is not what you think it is. Because what you're about to learn is that you have the whole thing backwards. And once you see it, you will never sign an insurance policy the same way again. So let's go back to the beginning, and let's make you the owner. Picture it. You own an insurance company. Every single month, millions of people send you money. They send it faithfully, automatically, year after year, in exchange for a promise. A promise to protect them from something they hope never happens. Most of them will pay you for decades and never ask for a cent back. Think about how extraordinary that is. There is no product to ship, no inventory to stock. You sell a promise, a piece of paper, and the world hands you a river of cash in return. It looks like the most perfect money machine ever built. But here is the first thing nobody tells you about that machine. Most insurance companies actually lose money on the insurance itself. They pay out more than they collect. Year after year, the core business runs at a loss, on purpose. Read that again, because it makes no sense yet. The business of selling insurance loses money selling insurance. And that loss is the exact reason these companies become some of the richest, most powerful institutions on Earth. To understand how a losing business turns into a fortune, you have to follow the money to the one place almost nobody ever looks. That place almost nobody looks is a gap in time. A small, quiet gap that turns out to be worth trillions. Here's how it works. When you buy insurance, you pay your premium today. But the insurance company doesn't pay out today. It pays out later. When your house floods, when your car is wrecked, when a life insurance policy finally comes due. And that later can be months, it can be years. With life insurance, it can be decades. So think about what the company is holding in the meantime. Millions of people are paying in every month right now, and most of the claims won't come due for a long, long time. Which means, at any given moment, the insurance company is sitting on a colossal pile of other people's money. Money it has collected, but hasn't had to pay out yet. That pile has a name. In the industry, they call it the float. And the float is the entire secret of this business. Because here's the magic. That money isn't just sitting in a vault. The insurance company invests it, all of it. It takes your premiums, money it will eventually owe to somebody else, and it buys bonds, stocks, real estate, and it earns a return on every dollar while it waits. It is investing money that isn't even its own, and it gets to keep the profit. Let that sink in. You hand them your money to keep you safe. And before they ever pay a single claim, they've been quietly using your money to make more money for themselves. How big does that pile get? Hold on to this number. By the end of 2024, American insurers were sitting on nearly $9 trillion in cash and invested assets. $9 trillion. That makes the insurance industry one of the largest investors on the face of the earth. And most people have no idea it's even happening. One man understood this better than anyone. Warren Buffett built one of the greatest fortunes in history on exactly this idea. He owns insurance companies, Geico among them, and he has said the float is like being handed free money. And better yet, he said, you get paid to hold it. Paid to hold other people's money. That is the real business you're in. So now the contradiction from a moment ago finally makes sense. An insurance company makes money two completely different ways. The first is underwriting, the old-fashioned bet, premiums coming in against claims going out. The second is investing the float. And here's the twist that runs the whole industry. A company can lose money on the underwriting, pay out more in claims than it collects, and still make an absolute fortune because the float is earning billions on the side. The insurance is almost a sideshow. The real engine is the money in between. And once you understand that the whole game is holding your money for as long as possible, a very uncomfortable question answers itself. Why does your insurance company always seem to take so long to pay your claim? Why the forms, the delays, the reviews? You probably think it's just bureaucracy. It isn't. The real answer is going to make you angry, and it's coming next. Here's the answer, and you're not going to like it. Remember the float. The company makes its money by holding your money and investing it. So every single day it can delay paying your claim is one more day it keeps earning a return on that cash. The delay isn't a bug in the system. The delay is the system. When you're stuck in the forms and the reviews and the "we're still processing your claim," you are not fighting bureaucracy. You are standing between an insurance company and its investment income, and it is in no hurry to let you go. And it's counting on one more thing. It's counting on the fact that you have filed maybe 2 or 3 claims in your entire life, while it processes millions. You are an amateur, playing against a professional who does this all day, every day. The company knows most people don't fully understand what they're owed, and that quiet knowledge gap is worth a fortune. Now, that number I told you to hold, nearly $9 trillion. This is why it matters. That ocean of float doesn't sit still. It flows into bonds, into stocks, into real estate, into the foundations of the entire economy. The sleepy insurance industry is quietly one of the biggest investors alive. When you picture a giant on Wall Street, you picture a bank. You should be picturing your insurance company. But holding all this money only works if the company gets one thing right. And it is the hardest thing of all. It has to predict the future. This is where the actuaries come in. Actuaries are the mathematicians at the heart of every insurer, and their entire job is to price the future using the past. They take centuries of data and calculate with eerie precision how many houses out of 100,000 will burn this year, How many drivers will crash? How many people will live to 90? They can't tell you if your house will catch fire, but they can tell you that out of 1,000 houses like yours, roughly 3 will. And that is all they need. They're not insuring you. They're insuring the statistic. And to know whether all that prediction is actually working, the industry watches one number above all others. It's called the combined ratio. And once you know it, you can read the health of any insurer in seconds. It works like this. Take everything the company pays out in claims, add everything it spends to run itself, and compare it to the premiums it took in. If that number lands below 100%, the company made a profit on the insurance itself. If it climbs above 100%, the insurance side lost money. And now the company is leaning entirely on the float to survive. Below 100, the machine is healthy. Above 100, it's bleeding and praying the investments cover the wound. And that word, praying, is the crack in the whole thing. Because this entire perfect machine rests on one silent assumption. It assumes the disasters never all arrive at once. The actuaries spread their bets across thousands of homes in thousands of places, confident that fires and floods will politely take turns. But what happens when they don't? What happens when a single event comes for everyone, on the same day, in the same place? In August of 1992, the entire industry was about to find out. And it would end with 16 companies simply ceasing to exist. To understand why that summer broke the industry, you have to understand how safe everyone felt going into it. For decades, South Florida had been quiet. No monster storm had made a direct hit in a generation, and the actuaries, doing exactly what they were built to do, looked at that long, calm record and priced their policies accordingly. The homes were cheap to insure. The profits rolled in. Everyone felt safe. That feeling of safety was the most dangerous thing in the room, because it was built on data that simply had not seen the worst yet. Then, in the early hours of August 24th, 1992, Hurricane Andrew came ashore south of Miami as a Category 5. Winds of 165 miles an hour. It did not politely take turns. It flattened everything in a single, concentrated blow. When it was over, more than 25,000 homes were simply gone, and 100,000 more were damaged. And inside the insurance companies, as the claims began to pour in, a slow and terrible realization set in. The numbers they had trusted, the calm, comfortable numbers that told them this was safe, were catastrophically wrong. The bill was staggering. Insured losses came to $15.5 billion, at the time the largest insured disaster in American history. And here is where the beautiful machine met its limit. All those premiums, spread across all those years, were nowhere near enough to cover a single event that hit everyone on the same night in the same place. The one assumption the whole model rested on, that disasters take turns, had just been proven false in the most brutal way imaginable. The machine didn't just stall. For some, it exploded. At least 16 insurance companies were wiped out by Andrew. Not damaged, not shaken, but bankrupted into oblivion. They had collected premiums for years, felt rich and secure the entire time, and then a single storm on a single night erased them from existence. The tide had gone out, all at once, and it revealed exactly who had not prepared. Warren Buffett, the man who built his fortune on this very industry, once described this exact moment better than anyone. He said, "It is only when the tide goes out that you discover who has been swimming naked." Andrew was the tide going out, and 16 companies were caught with nothing on. Now sit with the deeper lesson here because it is the whole game. These companies were not run by fools. They were run by mathematicians, using real data, making rational bets. And it still wasn't enough, because they had quietly assumed the future would look like the past. That single assumption is the fault line running underneath every insurance company on Earth. But Hurricane Andrew was one storm in one state doing damage you could see and measure. It was survivable. The industry rebuilt. What came 16 years later was something far stranger and far larger, because this time, the storm wasn't made of wind, it was made of paper. And a single company chasing the float to its most dangerous extreme would take that same fatal assumption and blow a hole not in one state, but in the entire global economy. You've already seen how that night began.
So let's go back to that conference room. The ringing phones. The $14.5 billion. Only now you have everything you need to understand it. The company was called AIG, American International Group. And it wasn't just an insurer. It was the largest insurance company on the planet, with around $1 trillion in assets and operations in 130 countries. This was the sleeping giant of the entire industry, the last company on Earth anyone expected to fail. And it fell because of the exact idea you've been learning this whole time: the float, pushed to an extreme so reckless it's almost hard to believe. Buried inside this enormous, respectable insurer was a tiny division of just a few hundred people. And that small unit had discovered a way to sell a brand new kind of insurance. Not on houses, not on cars, on Wall Street itself. They sold contracts that promised to pay out if certain bundles of home loans ever went bad. In plain terms, they were selling insurance on the housing market and treating it exactly like insurance. Collect the premiums now. Feel rich now. Assume the payout would never come due. It was the float mentality taken to its most dangerous conclusion. And they sold a mountain of it. This one small unit had written over $440 billion of these contracts. Protection against a disaster that almost nobody at the top of the company, its regulators, or its board fully understood. And then Hurricane Andrew arrived again, except this time it was made of paper. The American housing market began to collapse. But here's what made this so much worse than any real storm. Andrew hit one state. This hit everywhere, all at once. Every one of those loan bundles started going bad at the same moment. The exact scenario the model swore could never happen. The disasters did not take turns, they arrived together, and AIG was suddenly on the hook to pay all of it. That's the $14.5 billion in cash it was being asked to produce overnight, with far more behind it. The largest insurer in the world, the sleeping giant, could not cover the promises it had made. It had collected the premiums and spent the safety. If it went down, it would drag every major bank that had bought its protection down with it. So the United States government stepped in with the largest rescue of a single private company in American history, a commitment that ultimately reached $182 billion. That is how a boring insurance company nearly ended the global economy. Not with greed alone, but by believing one last fatal time that the future would look like the past. And now the final twist, the one that tells you everything about this strange, powerful business. The government didn't just get its money back. When it finally sold off its stake in the rescued company years later, the taxpayers walked away with a profit of nearly $23 billion. The machine was so powerful
that even its most catastrophic failure, in the end, turned a profit. Which leaves us with the only question that matters. Knowing all of this, would you actually want to own one?
So, do you actually get rich owning an insurance company? The honest answer comes down to that one number I gave you earlier, the combined ratio. And the difference between a good year and a bad year will tell you everything. Picture the good year first. A well-run insurer prices its policies carefully, the disasters stay polite and take their turns, and the claims come in below the premiums. Its combined ratio lands somewhere around 94%, comfortably under 100. That means it earned a profit on the insurance itself. And then, on top of that underwriting profit, it collects the investment income from the float, billions of dollars quietly compounding in the background. In a good year, the machine wins twice. It gets paid to sell the policy, and it gets paid to hold your money. This is how insurance builds some of the largest fortunes on Earth. Now the bad year. A single catastrophe rips through the portfolio. A wildfire season, a record hurricane. Suddenly, the claims explode past the premiums, and the combined ratio shoots up over 119%. The insurance side is now hemorrhaging money. In a year like that, the underwriting doesn't just fail to make a profit, it becomes a wound. And the only thing standing between the company and collapse is the float. The investments have to be strong enough to cover the bleeding. In the bad year, the side business becomes the only business. And that is the real truth of owning an insurance company. In a well-run one, the insurance itself barely breaks even over time. The fortune was never really in the premiums, it was always in the float, in holding that ocean of other people's money and putting it to work. The policy is just the bait that lets you hold the cash. Which brings us to what this business really is underneath all of it. You are not in the business of selling safety. You never were. You are in the business of holding the entire world's money for as long as you possibly can, and betting that the day everyone needs it back all at once never comes. Every insurance company on Earth, from the small local office to the trillion-dollar giant, is a money-printing machine built on top of a single, silent prayer. That the tide never goes out on everyone at the same time. Most years it doesn't. The prayer holds, the float compounds, the fortunes grow, and the machine hums along, invisible and unstoppable. And then, once in a generation, the tide goes all the way out, and we find out, all over again, exactly who was swimming naked. So here's my question for you. Now that you can see the machine for what it really is, the float, the delay, the beautiful math, and the fatal assumption underneath it, do you look at your own insurance policy as protection? Or do you finally see it for what it is? Your money in someone else's hands, quietly working for someone else? Tell me in the comments, and subscribe, because next time, we take apart another empire everyone thinks they understand, and no one really does. One asset, real numbers, and the truth the naive never see.